Anything that I do in life, whether it be business, friendships, health, decision-making, whatever it looks like, it has to have the compounding benefit to it. I don't want to spend a second of my life doing something that doesn't have compounding benefits or compounding nature to it.
Welcome to the Fully Funded Show. Whether you're a capital raiser, deal sponsor, fund manager, or LP investor, we've got the insights you need for investing success. Join Sam Silverman each week for expert interviews, insider tips, and strategies to fully fund your ventures. Let's go!
All right, we are back with the Fully Funded Show, this time with a close personal friend of mine, Craig McGrouther of Lone Star Capital.
Thank you so much for having me on. It's funny being on the other side of this. We've done hours of content together now, deals together, had experiences together, and now it's fun to be on your platform to connect to you today about whatever the heck you want to talk about.
Yeah, thanks for coming on. I think it's an interesting kind of talking point too. I think one to go dive into, it's just way more fun doing deals and business with, close friends and such. I think you guys at Lone Star have done an awesome job of keeping people that you're close to, right? The whole Beardsley family works together, which is awesome. So what's that been like in terms of just the culture piece of it, in terms of working with people who you're really close to outside of work as well?
Excellent question. So as you know, I'm a bit of a talker. I love my relationships. I might be the leader, in minutes on the phone. So I love to work the phone, and inherently we work with a lot of great people in this industry. And what ends up happening is a conversation about deals comes, a little crack joke here and there turns into more time on the phone together and deeper relationships. So what's kind of happened at a team level, Lone Star is very tight knit. Half the team is actually from basically the same area in the Bay Area. But naturally, not all of our capital partners and investors are from the Bay Area. But we've kind of also brought that tight knit feel to our community, to our capital partners. So it's a lot of fun to work with people that everything about them. What golf courses they like to play, what type of dinner they like to eat, what they like to do personally. You send each other pictures. So it really enhances your experience. And the fun thing about where we're at with Lone Star and the life cycle of our firm is we're kind of at the point where we can kind of say no to people that we don't really actually like to work with. We've got so much demand for our product right now, fortunately, that it's really about who we want to work with a lot of the times. Now, naturally, there's certain situations where you can't only steer the people you really want to work with in your deals, but we get a large enough bulk of people in our opportunities that we're kind of hand selecting for those deals. And oftentimes it's friends like you or other people in the business that we just really like as people. So it makes the experience of, raising money in your day to day that much better. I really don't feel like I work that much. Obviously, I'm always working, as are you. Everything is work ultimately at the end of the day, whether if you're working out, whether if you're, kind of putting marketing together, but it's a very enjoyable experience.
So let's take a step back to help us understand, for those of us who don't know, what Lone Star does, what your role is there, and also kind of how you got to be a part of that team and chose that direction to go.
Yeah, for sure. Well, there's a lot to unpack there. So of course, I work with Lone Star Capital. I'm the Director of Business Development. Lone Star Capital is a multifamily owner and operator, lead sponsor, syndicator, if you want to call it. We've got about $700 million of assets under management, about 4,400 units, exclusively in Texas, in Houston, which is our flagship market, Dallas and San Antonio. So we're looking to buy deals, call it from $40 to $60 million now in deal size. We will make some rare exception for smaller deals, but we've noticed that the smaller deals are just as much of an effort to raise as a $50 million deal as it is for a $15 million deal. But unfortunately, you can't really get to scale on the $15 million opportunities. So we are vertically integrated as well with our own property management and construction management in-house. We've got a couple of deal strategies that we like to buy. Strategy number one is, like everyone else, down the fairway value add opportunity. And then strategy number two is tax exemption opportunities, where we preserve some affordability with the city. We decrease our rents in exchange for a massive decrease in property taxes, which is often in a state like Texas, the biggest expense you get. So that kind of creates unique alpha and a cool deal profile that gets you great returns from a risk adjusted perspective. So that's who Lone Star Capital is. And then what was your next question after that?
Yeah, so what is your role really play in Lone Star in terms of what you do on a day-to-day basis,
Yeah.
what your function provides?
Yeah, so I'm the director of business development at the company. So effectively, I do all of the outreach. When we raise capital, I'm the one that is pounding the phones. So naturally, probably a good fit for me to be barking at people on the phone, trying to find capital, trying to find equity partners for the next opportunities. I do a lot of the content and ideas for our podcasts. So I do two podcasts. You've been on both of them, but that is the Fun Friday show as well as the Lone Star Capital podcast. I kind of do all new relationships, existing relationships, and kind of client success stuff as well. If there's a new investor form that comes through, a new inquiry, I'm there, speaking to them. I go to conferences all the time. I think this year maybe till now, I've been gone more days than I've been home. So I've been very nomadic, which of all people you can appreciate. It's a bit of a struggle. The waistline and the abs aren't there like they used to be to start the year, but that's okay because the wallet's full. But I'm basically going out and about, going around, finding equity, meeting people, getting relationships going. And the way I kind of look at it is really time leverage and value of that. So the lifetime value of the customer is incredible if you do get them early. The hardest customer to get is the first one. Then you've got to re-raise from them. But, to meet people, to get partnerships going, doing that at this age, I am 30, our firm is relatively young for, just any standard. And then let alone in the real estate world, we're babies. But we kind of look at it like, hey, if we really leverage our time, we hit the business hard for the next 5 years, like we have for the past 6, we're going to be in such an incredible spot. And you're not going to have to travel forever. But if you do it well now, your name and reputation will precede itself moving forward. So the goal right now is just to grind it out, meet everyone, kiss babies, shake hands, the whole nine to basically convey our value. And we understand that a lot of relationships take some time, but I'm the one that's kind of facilitating that, whether it be setting up dinners for our partners, getting everyone together, raising capital, sending out deals. And then, I now also fully spearhead the capital stack. So kind of taking people in, making sure that it's the jigsaw puzzles put together correctly. Because as you get a deal, you have a $20 million raise. We, typically speaking, syndicate. We have raised institutional capital, but I got to figure out, hey, there's a $500,000 partner here. There's a $4 million partner here. We're going to raise X amount of dollars. So you got to put that together. Naturally, some raises go really great for people and they can achieve their goal. And sometimes people come up with a goose egg, which is okay. We understand that's part of the process, but it's my job to make sure that there's no shortfall in the capital stack.
Yeah, so there's a few things I want to go unpack there. I think you made a really good point, especially right now, the last 12 to 18 months, capital has been a bit wonky, especially as it relates to retail investors and capital partners. When putting together the mechanics of going to do a $20 million equity raise, like what buckets do you put it into, right? Because you have your bucket that Lone Star raised directly for themselves in terms of their retail investors on their list. You have your co-GPs or fund-to-fund managers. You may have some larger check capital as well. Like, how do you go weight those different equations when looking at putting together that capital stack? And do you use anything in terms of like probability analysis or likelihood scenarios when looking at capital partners, co-GPs, etc.?
I think I'm very well suited for this role because it's always a beautiful mystery. People often ask, where's your capital structuring from? Because they see, the deals that we're able to buy in this market, particularly, which is no cakewalk. And over the last year since I've been at the company, I've been here for about 2.5 years now. And the answer is I have no idea how it's going to come together, but seemingly we put our information out there. We've built a beautiful machine to capital raise and market, and we always find the dollars for our deals by the grace of God. So it's always tough to say what, you always want to start with is people that you've done deals with before. And then taking on a new partner is actually riskier than people might actually think. So let's just say if you're someone who's getting into the capital raising business, maybe you've done raises before, but we've never worked with one another. It is us taking a risk on you, because you just got to think about this. If you are a capital allocator from our perspective, whoever we are saying yes to, we're saying no to someone else. And there's a really good example of that. We just went live with the deal today. No reason to say dates, but we went live with the deal today. And there is about 20 groups or 20 capital raisers that have emailed me asking for allocation and the opportunity. And we actually had the deal, for the better or worse, pre-subscribed blindly, essentially, from our event that you, of course, attended in September of 2024. So it's always very difficult to have that problem, have people say no. And it's also difficult for us sometimes to say yes to a new partner because we don't know what the experience will be like for them. But I also know that, like Chris Larson, who of course is a coach for your group, if Chris Larson says he's in for $3 million, you can, bank on the fact that $3 million is coming in. So we do like to have a blend of, I would say, at least 50% of partners being current or past partners, right? And then maybe a couple partners here and there that would be new partners to add on to our repertoire and kind of our bullpen of people who could be cornerstones for capital raising in the future. So I guess to answer your question, it's always an unknown entity who's going to come in and bring the money. But we've been very blessed and fortunate to be able to buy deals and actually have a very clean track record considering everything going on in the marketplace.
And something I think you guys do, probably one of the best jobs I've seen at, as well as most people go to a lot of events, especially in this industry. I think something that both you, Rob, Dasha, and the team do extremely well is coordinate the events that you go to as a mechanism of, really maximizing your time, right? So give us some background on how you put together your game plan for an event and kind of what that looks like for you.
Yeah. I hate to be this way, but I'll just admit it. I am very transactional with my time at conferences. It is strict. It's an agenda. I don't think at any of the conferences I've really been to this year, I met or bumped into anyone that I actually wasn't going to meet with prior to going into that event. So we are very intentional about it. So we've got a very large list of people in our database who might be capital partners, investors, so on and so forth. So what we do for our events is we either reach out to people via Slack channels like yours for the fully funded group, whatever it may be, whatever the event is, and find out who's going to go. It could be a mail merge. It could be a blast out to our individuals who will be going to the event or might be going that would, kind of fit into the bucket. If it's, let's say, NMHC, which is uber institutional, it's the highest level of, I would say, capital raising events, or I guess just equity events for the multifamily space, that, hey, we're not going to be emailing, probably fund managers or boutique capital managers. It's more going to be institutions like the ProMarks, the Torchlights, the Starwoods of the world. And then we'll have events like yours, which we prefer, BEC or something to the tune like that, right? Where we will email more of the fund-to-fund people, co-GP-like people, I guess individuals that would come in from 500K to 5 million in our deal. We'll email them. We'll try to set up a time mutually that works for all parties. And what we're doing is just really trying to get in front of everyone, see what they're up to, see if there's a fit to work together. And we kind of basically build out a calendar around the event where we can meet with people strategically to make sure that there's a fit or not. And we found that to be very intentional and good use of time. I would say that outside of your event, which we will be in the room for and actually be listening to the content because we're going to be participating, and your event's going to be really focal pointed around networking, which is why everyone should be going to it. But, if there is not curated events like that, we're basically setting up, a agenda prior to going. Typically speaking, we don't listen to any of the content on the stage. I'm ashamed to kind of admit that, but that's just kind of our strategy, but it's been very intentional. So we'll do that. And then typically speaking, obviously not for your event because there's dinners kind of around it. You've done a very good job of spearheading and coordinating that. We'll also then set dinners and have people come and kind of connect our network together. The beautiful thing, this happened at Best Ever Conference, right? You were in a room, you've partnered with us. And then at that table were some institutional people. There were some other, kind of capital allocators there. For everyone to kind of mix together, it's like a mastermind within a conference in and of itself. So we do meetings, we do deal blasts to start, then meeting setup, really good detail orientated, logistical coordinating of getting phone numbers, getting texts, getting emails or dinners together, so on and so forth. That really enhance the experience altogether. So that's kind of how long-winded, how we like to approach conferences.
Yeah, and I think you do a really good job of making it intentional as to this is our intention of going to the conference, right? We want to go fit in as many people as possible who are all in a geographic focus at one time. I think it also helps create a level of buzz too, right? Like if you look at a conference, you typically see Craig and Rob sitting somewhere in suits talking to people after people after people in terms of rounds, right? Which creates a level of scarcity in that dynamic in terms of kind of elevates your presence. So I think kind of building that platform, which you guys have done really well, helps a ton. And it also just shows that you're very, very prepared in what you do. I also want to pivot now too when looking at, right now there are a ton of deals out there, right? Way more than we've seen in the last while. I think the other side of it is becoming whoever can get those deals done are the ones who can go attract capital the right way. and you guys have had a great history and track record of being able to bring in capital really efficiently. What do you feel as though that you do to kind of set yourself out from other people who are competing from that same capital? Because if you look at the fund manager persona or the kind of that capital partner persona, they may see 5, 10, 20 deals a week that all look fairly similar in structure. What do you do to set yourself apart from those other people for people want to go keep working with you over and over again?
Yeah, I think branding and marketing has a lot to do with stuff. But so branding and marketing, always putting kind of content out there, kind of being in networks like yours, being in masterminds, doing a good job, also a track record. Everyone has to start somewhere. We just got really fortunate. How people make it and don't make it sometimes in this business is like such a, random luck of the draw. But I think that with Rob and Kent, it's not a mystery as to why. So I think if you just look at the founders of the company, they're two of the most bright people you're ever going to have a conversation with. I think that's just definitively true. Like you're going to be in that conversation as well as some of the smartest people you could possibly speak to is someone like yourself, Sam. So that's why we obviously love and we're so married together our businesses in many respects. But I think if you talk to Rob and you talk to Kent, you're just going to realize, okay, if I'm going to bet on a group, I'm just going to bet on them. I mean, one guy worked at the IRS, was a senior tax attorney for north of a decade, Kent, and is just a savant. One guy wrote 2 best-selling niche books, which I have right here on my desk, which create an immense level of credibility. You might have heard of these 2 books. 50,000 copies were sold, over a relatively short period of span. And that's a lot of books if we're not talking about the Harry Potter and sci-fi space. That is, you are a nerd in this space looking for some very specific information there. So those things really establish credibility, but then track record, full cycle in 2 deals. To some, that's nothing. To some, we're actually babies. But to others, like in this kind of syndication business, we're, the seasoned folks 6 years in the business. So I think that's some stuff that we do to separate. I think the other thing is we're very professional and on the dot. I'm a little bit casually dressed right now, but I think when you see us and you meet with Rob and I, we're suit and ties, and we look very Manhattan. And in many respects, I'm a Phoenician. I'm a Scottsdale guy. If I'm not, in a suit and tie, I'm probably dressed a little more casually. But at conferences, we're always dressed to the nines to basically make sure that we're serious, we respect you, and we respect ourselves. So I think just the level of professionalism and a little bit of the intensity that we bring, I think people are actually, in fact, attracted to it.
And kind of looking at your background too, right? Like all great points. I think you guys do a great job at branding, at marketing, at being super consistent and transparent. And if you talk to anyone in the space, when your group, your name comes up, like it's always positive things. Like you don't hear people with just negative things to say, which goes a very, very long way in terms of social proof and credibility. And people feel a high confidence as it relates to trust and ethics there too, which right now matters a lot. And let's pivot though to your background, right? Because you weren't always in real estate, at least in this capacity, right? Kind of what was your background prior to doing this, and why did you decide to make that pivot from being someone who worked more for yourself versus kind of joining a bigger team?
Yeah, it was a really difficult decision I had to make there. I guess it wasn't that difficult in retrospect, but it felt kind of like it just needed to be done. So to your point, I was a residential realtor, sold over 100 homes, probably, around $100 million of business in sales. So I was basically on path to kind of come into my prime. But I think the transition needs to be done because, do you want the whole grape or a slice of the watermelon? And the way I looked at things is I would rather, go really big in hopes that you make it. And I also knew Rob prior to joining Lone Star. So it was definitely a transition from, okay, I'm doing whatever I want, kind of when I want, within, the economic, benefit that I wanted to receive of basically labor for my dollars back. So I was selling a bunch of homes, but I just kind of knew that, if there was an opportunity to join a rocket ship, it'd be foolish to not go on it. And, I also knew Rob, saw him take nothing to something, basically in 2018, we became more reacquainted. In 2020, became very close. And it was very evident by just being around him and the conversations we were having that this guy is just an outlier in every respect of it. And if there was a way for us to connect together and work together, I thought there was going to be a mutual benefit. So we kind of had a very, unbeknownst to us at the time, organic kind of vetting process, courtship process of working together. I saw that he was just dynamic in every respect of it, a savant, I would like to call it, with him, just being able to be dynamic and really create nothing from something as a, 21-year-old, 22-year-old. Not very easy to do that. And then he saw me take my business from nothing to something and kind of being a hunter in sense and, only eating what I kill with residential real estate. So it was a mutual alignment there. But, the way I looked at it and made the pivot and transition, and I wouldn't have done it unless there was kind of a how could you not situation. But it really boiled down to this. I could always go back to selling homes. I could do that right now. I'm still licensed. I still have, people that reach out to me very often about wanting to help them with their needs, which from time to time I will help them and point them in the right direction. But you can always go back to selling homes. You cannot always go back to getting in at the ground level of the company. When I got to Lone Star Capital, I think we're about $200 million of assets under management. Now we're almost at 700 million. Of course, they could have done that with or without me, but I'd like to think that I helped fuel that growth. But it's one of those things where it just made too much sense to join a company like that. And there are very few opportunities in your life, if ever, that you get to kind of take advantage of it. So I'm opportunistic and I had to jump all over it. But it's certainly an adjustment, having to work with your friend who is your boss. He's 3 years younger than me. It's an interesting dynamic, but I left my ego at the door. I know that I'd be working for him, doing some of the stuff that he didn't want to do, but he also saw the value that what I bring to the table. So it's funny, Rob and I are very complementary in many respects. So we did really feel that this would be the perfect fit for us to work together. And I just got really lucky. I worked really hard. I also had many moments along the way where I could have quit and take the easy way out. Right when I graduated college as a baby face, you think I have a baby face now. When I was 22, I looked a lot younger, believe it or not, which I'm sure that's not a surprise to anyone. But I had to basically make no money and figure out how to make money in residential real estate in the Silicon Valley, which there's no deal flow. And the average listing is about $4 million. So good luck, kid. So I was driving Uber on the weekend every single day, kind of testing my conviction, figuring out if I'd make it, really just grinding and, getting nowhere in life. I graduated from the University of Arizona, where I was, kind of the man, if you want to call it, was doing well in Greek life through that whole system. And then I graduate and I'm making no money, living in an area that I don't like and doing an industry where, you're kind of just getting dunked on all the time. So it challenged my conviction, but I pushed through that. And I think that mindset has really carried over from my past life into this one where, urgency is really at the forefront for my mind. And, doing the right thing at all times is, the most important thing.
And for you too, like when looking at going from being successful in transactional real estate, right, in terms of selling and buying homes, you typically make decent money in doing so. But if you sold $100 million, you probably make between $2 and $3 million in terms of that time period. When looking at the earnings side of it, if you factor in commissions, I think something to think about is that when you make that jump to go into a space where the syndication space, it's pretty back-weighted in terms of your earnings and compensation. And I think a lot of people listening to this show were similar to you or myself, right? They were in a sales role or a high-performing corporate role, and they want something more for themselves. But to get there, you're taking a few steps back to go take, a few big leaps forward eventually. Like, how do you think about that as related to your career? And what advice do you have for someone who may be in the same position, who is thinking, hey, I can probably do this myself or be a part of a bigger team that does this in a certain way, but I may have to go give up something to get there and have that down period for a bit. How'd you think about it?
Yeah, no, it's actually interesting to your point. I kind of did the other way around. I was an independent contractor, kind of living the dream in a sense, a 1099, kind of doing what I wanted when I wanted with, the conformity and I guess the parameters of my clients' needs. I did a different way. And trust me, there's no dopamine hit like making 60 to 80 grand in a month. It feels really good. Okay. And also that's not a 60 to 80 grand a month kind of thing when you're in, tech sales or, as a doctor where it gets cut in half. You get all of it in your account. So to go from that to salaried with bonuses and obviously, as you mentioned, the other caveat, which is carry and deals, the world looks a little bit different, but I just kind of saw that, hey, there's more to life than just the residential side of things. I also saw that as something that wasn't as compounding as what Lone Star Capital would be if we went to the direction that I thought we would go to. So I just felt that, anything that I do in life, whether it be business, friendships, health, decision making, whatever it looks like, it has to have the compounding benefit to it. I don't want to spend a second of my life doing something that doesn't have compounding benefits or compounding nature to it. So that's how I really assess every decision to make in my life, from what I do to start my day to what I do to end my day, and what I do on the weekends, and if I'm going to drink or not drink, stuff like that. How will this actually benefit me? And I just felt like the pros really outweighed the cons in my specific scenario. But I can't act as if there's opportunities to get the ground floor of a company like Lone Star Capital growing on trees all the time. But it's also what you value and what you prioritize. For someone like myself, showing homes in Phoenix when it's 110 degrees in the summer in August isn't really like what I wanted to be doing when I'm 40 and 50 and I'm already battling with skin cancer because I'm a little bit fair skinned anyways. So, it's one of those things where I didn't really see myself wanting to do that forever. I actually want to be in Manhattan or in Oregon playing golf or doing this or that when it's really miserable out. So I kind of looked around, like, I really value my locational autonomy. I really value other things outside of just making a dollar. Of course, the money has to be comparable for you to make it make sense, because you owe that to your family and your future self. But for me specifically, it's kind of an internal gut test that I had to try something different, and I'm very grateful that I did it. So I guess to answer your question, which was a non-answer there, you just have to know that it's true in your heart and trust your gut, because I do think oftentimes the answer lies within there.
Yeah, and I think for people too, like something I always work through is that you can go build that rubric for yourself as well, right? And see what things you really care about and like weight them accordingly. Where for Craig, it seemed like location mattered a lot, right? The overall value he brought to a company mattered a lot, right? The ability to go earn on the 5 or 10 year, 20-year schedule matters a lot. I think it's something people don't talk about too, is that when you look at your earnings, yes, you have your current year earnings. You also have what's your 5 year, your 10 year, your 20 year, in terms of the path that you believe you can get to with the opportunity that you have. A lot of those things that are higher in year 1 or 2 may be less in years 10 and 20 substantially.
Yeah, by the time I get to 5 years in this business, and with the market kind of changing with how much volume we're doing, if we've got a $3 billion portfolio, let's just say, which we'll get there maybe, and I don't know, 10 years, 7 years, right? Well, I'll have, bonuses and carry associated $3 billion worth of real estate. That's going to be more money and more consistent money than I'd be making selling homes, right? The other thing to think about too is when you sell homes and the year's over, guess what? You're back to zero again. So there's not that much of a compounding benefit, and you really have to keep working. There's no leverage or scale to that, but there's a lot more leverage to rolling your dollars into the deals, keep that going, work the relationships, develop deeper and deeper and deeper relationships where you can create other income, where you can be living autonomously. I kind of look at this decision I made is, how can I get to the point where I've got, let's just say a round number, $10 million working for me, right? If you have $10 million working with you for a 5% return, well, let's do some quick math. That's $500K a year. It's $10 million from a real estate income perspective coming in, spitting out returns to you. That's kind of the number that I'm looking to get to in the not too distant future. Ideally, that's, the ambitious goal. But once you have 500K coming in, about 40 grand a month coming in tax free, you can do whatever the heck you want to do when you want to do it. It doesn't really matter. Your life is kind of set up. So as quickly as you can get into that car and finding the vehicle that you can get there in, whether it be selling a bunch of homes, whether it be investing in syndications, investing in debt, investing in PAVE, whatever that looks like, right? However you can get there, whatever the vehicle is that can help you create cash is the car you need to get into. And I just felt the long-term gain in this world was substantially more beneficial and was more in alignment with what I was seeking. So that's why I kind of made that transfer over. And I just want to get, people going, your nut internally, what you're looking to make, it's all by milestones. It could be, okay, I want to invest my first 500K. I want to get, $100,000 a year passive income coming in. I want to make $5,000 a month. Whatever that is, however you can get there quickest, you should probably do that, but also look at the long-term horizon of what could come if you actually build something. Like Sam, right now, the sacrifices that you're making to build up all your programs and stuff, you're maybe not feeling the benefit today, but you're going to start, enjoying those crops in 5 years from now, when you're really living large, when you've got a kids and family and stuff, and you can take them to practice and not think about, spending anything for their medical bills if anything like that comes up, taking them and sending them to amazing vacations or private schools. I want to live a very full and rich life. And I think you can do that when you kind of get into this world of things and you really hit it hard and leverage your time when you're young.
Yeah, the compounding piece of getting in early and being able to go defer certain gains, short-term type gains, for much, much more overall in the long term. I think it's a place where a lot of people want to get to, right? Some people are in a position where they can't go defer that short-term gain to go think longer term. So I think when people listen to this, like the first thing is getting yourself to a place of stability where you can actually go start thinking, think of your life as a business, right? If you're working in a business every single day, you likely can't work on it. So if you get your place to a place of stability, you can go work on the business in terms of your life and direction, what you want to go do. And yeah, go ahead.
I was just thinking about this. It's like we kind of talk about this, and I'm sure you've had investors say this. Let's just say you have $100,000 you want to invest, right? And people looking around, okay, well, what can I make for $100,000? So on and so forth. And it might only just be $5,000 to $6,000 a year. I say only, that's a very healthy amount of money from passive income. But they might say 5 or 6K. It's like, oh, well, that's not going to mean that much in my life. But if you start stacking that, and you've actually cemented this concept in my brain better than really anyone else has when you kind of break this down, just the value of stacking that year and year in and year out. If you do that for a decade, and you get some good market tailwinds there, you get some nice IRRs kind of stacking up, you don't go backwards, you are going to have so much extra cash flow and build up such an amazing nest egg where you can kind of start doing and living life on your terms. You can kind of start doing what you want to do with your life and your time. You can kind of work out of a place of passion, not a place of necessity.
Yeah, I mean, even if you take that 100K and you look at a 12-point, return overall, you're looking at 6 years is 200, 12 years is 400, 8 years is 800, right? Like it keeps compounding, right? Over and over and over again. And those numbers aren't right. But like looking at the, every 6 years, you can go double it. If it's 12, right? Every 5 years, if it's 15, in terms of looking at the stacking behind it. So that's a huge piece of it, right? Getting in early and being patient in a lot of things. Also, too, depending on where you are in life, too, that money's not always best invested. And what I mean by that is that I talk to people a lot who have, 50, 100K to go play with. And not that it's an insignificant amount of money. It's just at certain points in your life, your first goal should be, how can I go invest that to make more money myself? Like if you're making 100 grand a year, your biggest investment should be, how would I get to 250? How would I get to 500, right? And figuring out that path, that will pay you much, much more longer term to be able to go play with than invest in 100K and kind of just sitting on it for a while too. So not saying don't invest it, but figure out what that best return is for yourself overall and how you can reinvest it into yourself to level yourself up as well prior to just kind of stacking money and kind of compounding that way too.
Yeah, and that $100,000 to your point there, that's such a key distinction. If you're, in a situation where you're making, 500K a year, 300 grand a year, doing tech sales, and you're doing well, and you want to go down that route, then great. I recommend you investing it into maybe hard money accounts, debt funds with our friend here, Sam, with a group like us from multifamily. You compound that wealth, you do a great job. But if you're someone who doesn't like their situation right now, you want to have an outsized return, you might have to use that $50,000, $100,000 as fuel for your startup costs and your fuel, kind of your go for broke, get yourself going kind of money. And I lived at home for 3.5 years post graduation. So I was able to be in the game and kind of play where I am right now because I didn't have really any expenses. So, I was fortunate to have a family structure where that was possible in the Bay Area prior to moving to Phoenix and getting into real estate again out here. But depending on where you're at in your life, you're right. That investment back into yourself could allow you to get into real estate, in the real estate game, could allow you to get to the next phase in your life where you can make a lot more money than what you're doing currently as an employee. But you know what? Entrepreneurship's not for everyone. I also think that we're in this world right now where everyone wants to be an entrepreneur. It's like, well, guess what? I wouldn't want to do and start my own Lone Star Capital. I would be at peace with Lone Star Capital. But if I was the case, I would just be selling homes still because I don't think I could do that. So I think people need to also have realistic conversations about what their capabilities are. I think my skill set is very descriptive for what I'm doing right now. It's very niche in that sense. Either be, doing something in sales, relationship building. That is my highest and best use. I think sometimes people are a little bit unrealistic with what they maybe can achieve. And also some people are probably selling themselves short. So just be honest with yourself and be okay with the outcome if you're going to take that risk.
Yeah, it also just matters what you want your life to go look like too, right? Like on my end, I know I've lifestyle wise up here where it's pretty good right now, but you also don't factor in the 5 or 6 years of working 80 to 100 hours a week, locked in an office, building something up where you can go do that, right? Where you can go make those sacrifices and give yourself the optionality long term. It also gives you runway when looking at the entrepreneur side of it too. If you think about this, okay, I have $200,000 in cash. I have expenses of $8,000 a month, whatever it may be. you've got 2 years in terms of your runway to go make something happen, where the more runway you have from passive income, from other forms of cash flow, from lower expenses, if you do want to go take those risks, it gives you a longer likelihood of succeeding. I think something we'll see, at least in this space too, is if you can be around for a long time, you'll usually end up pretty well off, right? If you don't have any kind of major setbacks and you can just hang around and be right for people for a long time, you're usually in a good spot. It's when you have to go make decisions based on short-term income that it shifts. Also, I think Craig made a great point too when looking at not everyone should go try and be an entrepreneur. Like, you have a lot of the good things get glamorized, right, in a certain way, if that's a word, but they get highlighted in this way that it makes it so appealing to go do it. You also just have a lot of things that also really suck too, right? Whether it be the hours, whether it be instead of getting paid, you're actually paying over and over again, paying people, paying vendors, right? Like, it's a huge swing in terms of your stability too. So I think if you're kind of thinking about that route, if you want stability, it's probably not the best thing for you. Maybe eventually you can get there, but at first, definitely not. But before we hop here, one point I'd want to have Craig talk through is just like what's your quick state of the market as it relates to multifamily? I think you guys see a ton of deal flow, a ton of good relationships on the debt side, the broker side of the house. So I can talk entrepreneurship all day long. But just before we hop here, for people who are in the multifamily market, give us your take on what's going on and kind of what you see coming.
Yeah, before we get to that, I just want to make a point here. It's very well documented that Sam, just for everyone's record, I know he lives a very nice lifestyle now, but for the first 6 years, it is well documented that Sam had, days and nights where he's working basically, 7 to 7 and grinding it out to become a top salesperson. Whether it be Rob Beardsley doing the same or myself, you only see where we're at right now. It's like finished product syndrome. I just made that phrase up, where you look at where we're at now and you act as if like, oh yeah, that's how it's always been. It's like, well, no, that's actually not true. You were grinding in the shadows and the darkness, and then you get here after almost a decade of absolutely grinding it out. So just realize that the path is really going to be choppy and not linear and a struggle. Okay, on to the multifamily market update. I think the biggest issue right now, there's 3 variables that are tough. Interest rates are a variable. Operating costs are a variable. So operating costs includes property taxes going up and insurance going up. And then the other variable that I think is not as talked about as much is supply. So supply, when the market went gangbusters in 2021 and 2022, you could build below replacement costs and then sell it for, a really nice gain there. That's how you make money in development. Well, with the interest rate market changing, with the market softening, there's a lot of supply coming online and a lot of competition now, which is kind of having rents get compressed or actually go down in many markets. I think Austin is one of the darlings in the country. People love to invest there. Well, guess what? You've got 50,000 units, which is about 15% of supply coming online in Austin. You can't overcome that. That's not factored into your business plans. That's really causing evaporation of gains. So, from a multifamily perspective, I do think the way you should factor investing right now from a safety perspective is luxury or necessity. What does that mean? A luxury is working in an office. You're working in a home office, I imagine, as am I. So, an office would be a luxury. Retail would be a luxury. What's a necessity? Probably workforce housing, where, the blue collar folks of the world and the backbone of the economy and the most regular people are living in. So, that's where we're at here. So it's a great asset. It's a great product to be in, but we're going through some challenges everyone is dealing with right now with these variable costs coming in. As I said, insurance, supply coming online, and interest rates being kind of difficult. But at the same time, when you've got this uncertainty, when you've got difficult fundamentals going on, you have a really great opportunity to get outsized returns on investments that you make today. So the great news is that you're able to get deals at, what would be considered a discount from where they were before. And I think those who might be gun shy to make investments right now, and I'm speaking more to those who invested in 2021 and 2022, if you're crazy enough to invest with sub 4% cap rates, you should be even bolder to invest everything and more if you're getting north of a 5.5 or even a 6% in some cases in some of these markets. So it couldn't be a better time to invest because of right now. But we're going to see a lot of challenges coming up still. I would say we're probably in about the third inning, if we want to use a baseball analogy. We're probably in about the third inning of the distress in the marketplace, with it getting slightly better with light at the end of the tunnel once we kind of get through this rate hike environment and once we get through the supply issues that will kind of all be coming online ending in 2025 or so. So I think this year and 2025 will be incredible years to make investments. 2026 and 2027 is when we'll actually start to seeing legitimate rent growth. But right now, when things are choppiest and murkiest, is when you want to be bold and really make your plays. So I'm investing, a lot of my money personally. I'm not telling anyone to do anything I wouldn't do myself. For instance, Sam knows this. I fixed up my house and sold it. And those proceeds that I took tax-free using the tax code, I rolled everything into one of our deals, which is maybe going to be one of the best financial decisions I've made in my life. I also bought another home, but I used more leverage. But with that said, there is an awesome opportunity to invest in multifamily right now. So the fundamentals are looking good. There's certainly a lot of negativity, a lot of headlines that are not looking very good, but that's exactly when it's a good time to invest, conversely, naturally.
Yeah, I like it. I agree with a lot of what Craig said, especially look at supply, right? Supply came on board and a lot of supply is being delivered this year, next year. But when you look past that, there's not a lot there. And when rates spiked up, the model to go build dropped off significantly in terms of profitability, in terms of risk reward, in terms of headache and unknowns. And I think what we're going to go see is that we may see flat or negative rent growth for the next 12 to 18 months. But from there, once all those new supply are filled up, you're going to, the concessions are all burned off. You're going to see huge amounts of growth because there's nothing else coming on board for quite a while. So yeah, I definitely think it's a really good time to go get in when looking at opportunity, especially relative to the past few years.
Yeah, the consumer also just got to realize this right now. The consumer is very hurt. There's no more free money, no more Biden bucks floating around the market. Jobs have been cut. Jobs are making a lot less. I think we're unfortunately in a stagflation period right now, which is a whole other topic of conversation here. Ask your local economist for information on that one, on stagflation. But it's going to be a very challenging time here coming up. I also think there's, generally speaking, though, and this is kind of the tailwinds for multifamily real estate and build-to-rent communities, is a push to really people being renters for longer because it's so expensive to own anything. And also, there's a lot of people out there, and I think you're inclusive of this, where you don't want to own a home or actually live in a home anymore. Why would you want to do that? You want optionality. And I think the country is looking a lot more like that. And the wealth gap has never been larger. So apartments have never been a better investment, in my opinion, due to those factors.
Yeah, I agree. I mean, I had this conversation, especially being in Tampa. A lot of my friends here are in real estate on the transactional residential side, and they try and sell me homes really frequently. And I don't plan on owning anything for a very, very long time. I think right now, at least my take on it is most things I would look at buying, I have 20% down on them in terms of cash. I have all the closing costs that you incur. And then in turn, my mortgage is likely between 30 and 60% higher than it would be to go rent that same property or same house, condo, apartment, like whatever it is. And then if I say, hey, I want to go move in 2 years, I then likely go eat between 7 and 8% of that home purchase price to go sell it in transaction costs. So your total cost of ownership becomes extremely high if you don't see massive appreciation in that period of time. I think I will own a home again at some point when it's like I'm having my family here, I'm not moving, like I'll be here for 10 plus years. And it becomes purely an emotional lifestyle decision versus an investment that's financial.
Yeah, the logic is starting to get thrown out the window to owning in a lot of spots, and also just to re-underwrite Texas and Florida, as these are markets that we invest in. You've obviously owned in Florida in the past. The crazy thing about the market right now, single family is very stable, but those two markets are actually going to get probably hurt pretty badly coming up because, yeah, sure, you might have a 2 to 4% interest rate on a 30-year note, but those aren't the problems that you're dealing with right now. Those are some of the costs, but when homes go up, call it 40%, 60% in some cases, Tampa Bay even more than that, Dallas even more than that. Well, those states don't have locked in or low property taxes. So you have insurance going up like crazy and your property taxes going up like crazy. Although you locked in a fixed rate, call it, 3.5% note, your payment now might be 40% more than when you initially bought your property, while your dollar is not going as far. So these are very difficult things that a lot of people need to face right now. So the single family market in those states might be a little bit soft, but you're not making a home purchase right now in those locations, as I mentioned, unless it's purely emotional, which is fine, but it's emotional. Just
Yeah,
realize
and
that.
I think we'll see about Florida too. Like the insurance piece in Florida has been really big. I mean, I've had to evacuate where I'm staying twice in the last 3 weeks, and that's a big piece of it, right? When you look at issues like global warming, when you look at issues like how often these, once to 100-year events are now happening in terms of the damages that it causes, like there's a ton of people in Tampa and surrounding areas who won't leave their homes for 6, 8, 12 months from flooding, from issues like that as well. And in turn, insurance companies have to go value that premium back into it. Where if that rate goes from being, 1% per year of your home price to being 5, right, or 4, that's a massive, massive swing as it relates to affordability. And in turn, I think you'll see a lot of things in the insurance industry change here, especially for, if you're living in Florida and you want to live somewhere nice, most likely you have a desire to live on the water. And in turn, you're more susceptible to natural disasters, which we've seen. Hope this trend doesn't continue, but more and more happening locally as well.
Yeah, insurance companies need to protect themselves. They need to have the underwriting right. And with where it is right now, it doesn't make sense. And that will affect your purchase price on a property moving forward. It will compress your numbers because people look at those payments adjusted in there. So it's a difficult thing. Investing is not a perfect science all the time, but you just try to make the most educated choice time in and time out. And you look up and hopefully you've got a nice portfolio.
Yeah, I completely agree. But Craig, thanks again for coming on.
Thank you.
Thank you for tuning into the Fully Funded Show hosted by Sam Silverman. If you are enjoying the content, let's take your journey further in the Fully Funded Mastermind. The Fully Funded Mastermind offers more than just insights. It's a mastermind community designed to solve the real challenge of raising capital. By joining, you gain direct access to strategies, coaching, and a network dedicated to turning your financial goals into achievements. Don't let capital raising be a barrier to your success. Visit fullyfunded.capital to explore how our mastermind community can pave your way to financial growth.
Thanks for tuning in to the Fully Funded Show. If you enjoyed today's insights, hit follow, share with your investing pals, and drop us a review. Connect with us on social media for bonus content. Your success is our mission. Keep those funds flowing. See you next time.